Are we making too big of a deal of a 470-point swing on a $26,000 Dow?
No, we're not. We're not in the context of really what's at stake here in markets that had forgotten that a deal hadn't been done, markets that were all-time highs positioning that had changed, a VIX that was at 12, a market that had become essentially dependent upon a Fed spoon-feeding more stimulus in the form of, dovish rhetoric, how should we say, which I don't think, by the way, Richard Clarida yesterday said, I don't see us moving in either direction anytime soon. So I don't think there's more help coming from the Fed. So I think the market's response so far has been appropriate. And technical levels, if you want to start just getting into the mechanics of the market here, look very, very, I think we're at a cautious level. If you want to look at the S&P that's trickled back down to the 50-day or even some credit readings in the form of the high yield index breaking through the 50-day, which it hasn't done to the downside since October 3rd, which, by the way, was the last time we really saw the VIX spike like this. So I think markets are responding appropriately.
I'm glad you brought up the F word, the Federal Reserve.
Oh.
Because here's the thing. We always had that Bernanke put. Remember that from years and years ago? And I wonder, is there a Powell put as well? And here's what I mean by that, is that if the trade war, if we don't get a deal, if it ratchets up, if the tariffs do get increased, can a dovish Fed come back in and save the day, so to speak?
Well, some would argue that maybe this is in an attempt to push the Fed in a direction that clearly the administration has been pushing. I think people that expect the Fed to be, again, this preemptive cut, I think, was ludicrous. I think you have a case here where the Fed will respond, market conditions and financial conditions, which essentially will then have an impact on, how the wealth effect, asset prices, all the things that the Fed are part of their calculus, will move the Fed. We've seen that in the past, and arguably that was part of the dynamic that really had the Fed change their language aggressively come early December. So, but I think to expect that overnight, and for markets that really still are not far from all-time highs with an earnings season that was okay, but again, guidance in the near term that wasn't tremendous, I think markets should be cautious here.
Well, it's weird because think about this, Tim. If the tariffs go up, theoretically, prices will get passed on to consumer, raising inflation. The Federal Reserve is a bunch of smart people, but if you just look at the data, you'd say, okay, inflation is heating up. We'd better raise rates. But we'd all know that inflation is not actually heating up. It's simply the tariff effect. Right. I mean, you remember the old Greek story with Scylla and Charybdis? I do wonder if the Fed is sort of caught between those two rocks.
We are rocks. It's a Sisyphean kind of dynamic here. If you think about also, how about that Fed report that came out yesterday that talked about asset prices and talked about debt levels? Sounded like a Fed that was a little bit worried about an asset bubble, didn't it? So those are not comments that you're getting from a Fed that thinks that they should be throwing a lot of gas on the fire. And I think, that's right. I mean, I think the dynamics here are very, very challenging. But let's be clear. There's a point at which this really, for an administration that's been keeping score against the market, and that is truly how they are grading their success, is going to have to answer to this dynamic, rightly or wrongly. That's what we've got here, Brian. And I think that's where the pragmatic approach for market players and tacticians. Let's get away from This is market theory.
Don't get up and pull off the mic just yet. Why don't you sit tight? We're going to do our morning RBI, and I want you to respond as well. Okay, so hold up for this.
Love this.
Your random but interesting thought of the day is a poll we put out on Twitter asking for your take on the trade negotiations. If you were Trump, what would you do? A, make any kind of a deal ASAP. B, compromise on some stuff. Or C, hold out for all you want. Now, the majority of you said you'd compromise on some stuff. We expected that. But look at this. 45% of respondents said they would hold out to get everything they wanted. Only 8% said make a deal as soon as possible. Random, but interesting. Tim, are you surprised? 45% of those people said hold out. Stock market be darned.
I'm A little surprised, although, look, that's the part of the country that's not holding semiconductors and Apple stock. I mean, those are the people that actually are looking at the longer-term dynamics of really what were we expecting to truly accomplish in this China trade spat. Wasn't a war at one point. Maybe it's a war right now. China 2025 made in One Belt, One Road. China's concern about high-tech supremacy and control of the internet for the next 100 years is something that I don't see them giving a whole lot of ground on. And intellectual property rights are one of convenience in China, where it serves the Chinese government. Let's be clear also, you heard from Intel, you heard from Texas Instruments just recently in earnings season talking about a Chinese dynamic, which sounded like already there's pressure and they're competing aggressively with Chinese companies that do what they do.